Why is the US dollar suddenly acting like a massive financial dividing line right now? It's giving global companies a turbo boost while it's leaving some Main Street businesses behind. It sounds pretty strange. You'd think a really weak dollar would affect roughly everybody the same, but it's actually splitting the stock market in two. So, right now, an index of America's biggest global exporters, these are the companies that sell stuff all over the world, it's up maybe 21% this year. Now, meanwhile, if you look at an index of companies that mostly do business inside the US, like your local realtors, your banks, your utilities, it's only up 5%. That's the biggest performance gap since about 2009. So, what's up with the split? Well, it's the dollar, specifically a weak dollar. Now, the US dollar itself, it's dropped 10% this year against a basket of other major currencies. It's worst annual performance in over 2 decades. It's a big deal. Why the hell is this happening? There's two major forces. You've got monetary policy. The central bank has signaled it's ready to cut interest rates. That makes holding dollars less attractive to investors. Then, secondly, you got trade and political policy. The administration's trade stance has caused global investors to rethink their exposure to the US, leading a lot of them to hedge their bets by selling dollars. Now, if you combine those two things, you get a weaker greenback. And that's where things get interesting. That's the mechanics. When the dollar weakens, it's going to set off a financial domino effect that reshuffles who's going to win and who's going to lose. If you want to think about this, imagine two companies. One, a global tech giant, is going to be selling cloud services on devices across Europe and Asia. The other is a domestic realtor that's importing most of its good from abroad and selling to American consumers. Now, let's say both of them earn a billion in euros from their European operations. If the euro and the dollar are equal, that's 1 billion in euros converted to 1 billion in dollars. But if the dollar weakens, let's say the euro now buys $1.10, that same 1 billion becomes 1.1 billion when it's translated back to US dollars. It's a free $100 million boost just because of the exchange rate. That's a translation effect. And it's a huge reason why global firms love a weaker dollar. But there's another benefit, and that's competitiveness. A weaker dollar is going to make US made products cheaper abroad. If you're an American selling stuff like cars or software, medical equipment, your products look cheaper on sale to overseas buyers. That means higher sales, higher demand, and better margins. It's basically a double bonus. Foreign profits are worth more, and foreign customers buy more. Then there's a flip side. Domestic based companies, especially those that import goods, get none of the benefits. Instead, they get whacked by this import cost problem. Let's say your domestic realtor needs to buy clothing from factories in Vietnam. To pay those suppliers, it's got to convert US dollars into Vietnamese dong or euros. But now, because the dollar's weaker, each dollar is going to buy less foreign currency. Now, suddenly, all of your imports get a lot more expensive. Here's where things get kind of ironic. Whenever the dollar strengthens, companies rush to their earnings calls and they're going to complain. We lost money because of currency effects. But now, when the dollar weakens and helps them out, well, you're not going to hear anything. Now, if you can put it bluntly, you're going to hear about currency effects more often when the dollar strengthens. But with management, they're never really going to say we got bailed out by currency effects. So who's celebrating this right now? The winners are going to be global tech companies or major industrial exporters and companies with lots of overseas revenue. Some have even told investors that they expect a 2 percentage point boost in revenue growth next year just because of these favorable exchange rates. Now, meanwhile, there's losers, and they're the ones who are stuck to the domestic economy. Utilities and banks and small businesses that import goods, they're screwed. For them, the weak dollar is going to squeeze margins and raise costs without giving any offsetting benefit. It's like the economy handed out free espresso shots to the big guys, and the little guys get tap water. So the big question you got to think about is, will the weak dollar's benefits outweigh the costs? That depends on why the dollar is weak. If it's because of looser monetary policy, basically the central bank going out and making borrowing cheaper, that could actually be good for everybody in the long run. That's a good thing. Now, lower rates are going to make credit more affordable. It's going to boost your consumer spending, and it's eventually going to lift all of the boats, especially domestic ones. But if that weakness is coming from policy uncertainty or trade disruption, the pain keeps going on, especially for small and mid-sized importers that can't easily deal with currency risk. And either way, the weak dollar out there is already redrawn the map of corporate America. So this weakening US dollar isn't just a headline about foreign exchange. It's a financial filter we're dealing with, one that decides who thrives and who struggles in today's economy. You've got global companies out there. With revenue streams in multiple currencies, they're getting a tailwind. Domestic companies that are relying on imports and American consumers, they're flying into a whole bunch of pain. So for every American stock, its true performance is going to depend not on what's happening on Main Street, but it's going to be in the global currency markets, the global economy. Because the next time you hear somebody say the dollar's down, you'll know that for some companies, that's a sound of money rolling in. And we're not even talking about the impacts of tariffs on everybody, which amplifies these problems.